Growing up, I always felt like the poor kid. I know we weren't poor, we were middle class, but rich and poor are relative terms. It seemed like whenever I went to the other kids' houses in the neighborhood, they had nicer toys, finished basements, they could afford to go on vacations more often than my family. I always felt a little bit insecure about that. And fortunately, my parents sent me to a private high school, but that only exacerbated the problem. I was surrounded by the richest families in Buffalo, and my insecurities around money only intensified. So when I went away to college, I started as a mechanical engineer. But after 1 year of college, a friend of mine handed me a book, Rich Dad, Poor Dad. And I said, "What's this?" And he said, "Just read it." And I did. Hi, I'm Hibbard. That book completely changed my life. I marched down to the guidance counselor's office and I said, I want to change my major from mechanical engineering to finance because I need to learn everything I can about money. And she said, "Really? Are you sure?" And I told her, "Yeah, even if I make a lot of money as an engineer, I need to know how to protect it and I need to know how to grow it." And that was so important to me that I completely changed the direction of my life. Well, it's been 18 years and I'm still on this path of learning and teaching about money. And over the next 6 videos, I want to share with you some of the most mind-boggling things I've learned about money and value, and why so many people feel stuck financially. I also want to share with you some of the misconceptions that plague even the most seasoned experts in the industry. To my disappointment, I didn't learn many of the things I wanted to learn in school, even studying finance and even staying for an MBA. I had to learn most of these things about money and value on my own and from watching great series like Hidden Secrets of Money by Mike Maloney. This series is an homage to that series, and I want to share with you some of the things that go even further and are even more foundational. The problem I had is that the further I went down the money and value rabbit holes, the more I realized it started to feel like a second job. It took all my time watching the news, checking the markets, monitoring my investments to see if they were up or down or if I should make a change, and that's not how I wanted to live my life. I was looking for a solution that was low maintenance where I could set it and forget it. And fortunately, over the last 18 years, I found a solution that works beautifully for me. So now I can spend my time hiking in the woods, spending time with loved ones, reading books, or whatever is interesting to me. In this series, I want to share everything I've learned about money and value and how you can create a very simple investment strategy for yourself. Or, as you'll learn, it's more of a saving strategy than an investment one. Of course, nothing here is financial advice. This is all part of the financial education that I wish I had when I was in school, and I think everyone should know these foundational concepts. Warren Buffett has famously said, "Price is what you pay, value is what you get." And he's right. And that distinction between price and value is so important, it underpins everything we're going to talk about in this series. What is intrinsic value? What is extrinsic value? What is a store of value? And more. So let's talk about all those things, but first, let's go somewhere a little more comfortable. So why is the distinction between price and value so important? Well, basically, everything we do in life is a constant series of trades. And I don't just mean economic trades related to money. I mean everything. We trade our time, our energy, and yes, our money. And price is what we pay in each one of those trades. Value is what we get. So if we're not happy in our lives, then we've probably been making a series of bad trades. So if you want your life to be more valuable and more full of value, you have to pay attention to the prices that you're paying and the values that you're getting. So let's take a step back. What is value? How do we define it? A lot of people say that value is the certain dollar amount that something has in the store or on the stock exchange. I don't think that's the best definition. It's not really helpful, and it doesn't allow for that subjectivity or the opinion of the valuer. I think the easiest way to think about value is quite simply perceived benefit. Perceived benefit, that's it.
And so if you perceive a certain benefit now versus the way I perceive a certain benefit now, we're going to assign different value judgments. Similarly, what you perceive as a benefit right now might not be a benefit to you later. So your own value judgment can change over time. That's perfectly natural. That's what happens to all of us all the time. And in fact, this is a beautiful thing. The fact that everybody perceives everything different at all times is the reason that an economy can exist. If we all assign the same value to everything all the time, no one would make a trade. If everyone had the same value judgment, no one would make a losing trade. And if no one's willing to make a losing trade and everything's fixed, no one could make a winning trade. So it's actually a beautiful thing that we all perceive everything different at all times. That's what allows us to have an economy.
Growing up, my dad had several rental properties, and you would think that that sounds like a pretty rich business proposition, but these buildings actually cost him money, and it was a source of a lot of frustration, a lot of anger between my mom and my dad. Over meals at the kitchen table, my mom would get upset. When are you gonna sell those stupid rental properties? He either couldn't rent them out, or when he did rent them, the tenants didn't pay, or if they did pay, they would do so much damage to the building while they lived there that my father would sink a lot of money in trying to repair them. So over the years, I learned that if you're gonna own real estate, it's not an automatic way to make money. You have to have a lot of things go your way, and you have to manage those buildings properly. And at one point in high school, my dad took me to one of these rental properties. And as we were driving there, I couldn't believe how rough the neighborhood was. Everything was beaten down, broken concrete, smashed glass bottles. And I thought, why would my dad own property in this part of town? But he did. He thought it was a way to make money. And he learned, and he showed me, that that is a way to lose money. So of course, in the case of real estate, I learned an important lesson: location, location, location. But more broadly speaking, when it comes to investments of any kind, I learned that any investment requires an ongoing expenditure of time, money, and energy. It's not a guarantee that you're going to make a profit. You have to do things right. And if you're not willing to put in that time and energy and money, then you might not make a profit. You might actually be worse off as a result of a bad investment than if you chose not to invest at all.
Every one of us is saving and investing for the future. We might have different goals, but we all have that in common. However, most people think that holding on to US dollars is a form of saving, and turning those dollars into any other financial instrument is a form of investing. I would like to challenge that notion. I would argue that holding a US dollar is already a form of investing, and it's a form of investing that is guaranteed to lose. We know for sure that US dollars, like any fiat currency, are going to lose value over time. So if you're holding a large number of dollars, you're choosing to lose value with that portion of your portfolio over time. So what is saving? Well, saving is holding a real form of money. In my mind, it's gold, silver, and Bitcoin, because the free market tells us that those are money. Those are held for monetary reasons. They're not circulating throughout the economy as currencies.
So my mom worked almost her entire career in banking. She spent over 20 years at the same job. And one bank she worked at, she had a great 401k, good salary, and she owned stock in the company. But one day, the bank filed for bankruptcy. So she lost her job, and she lost a lot of money in the stock market because the bank stock crashed. And so I asked my father about this one day, if he ever owned stock, and that's the story he told me. And he said he got a little bit scared of the stock market because he learned that not every company is as strong as it looks on paper. And just because they can pay their employees well, that doesn't mean they're good companies. It doesn't mean that they're managed well or that they're going to survive for the long term. So I learned a pretty early lesson that centrally managed companies, which is all companies, they could fail. If they're not managed correctly, they will go under eventually. And so investing in a company is a risk, just like investing in real estate. And if you do it well, you can get a return on your investment, which is great. But it's not a guarantee that it's going to work. And most investments do fail. Most companies go out of business.
So what I found was several things. Number one, most investors are reluctant investors. They don't really want to invest, they just do it out of a default mode. They want to avoid the harms of inflation, and they do what most people do, which is buy stocks and bonds. That's the mainstream advice. Most people do it, but it's my belief that most people don't want to do it, they just don't want to fall behind. So as a result, most people buy major indices like the S&P 500 or the NASDAQ, but because so many people are doing that, it's my belief that those indices are overbought. In other words, I think people are paying too high a price for the value that they're getting. I think for most people, the value that they're getting is a belief that they're doing the right thing. They're not actually buying a prudent financial investment. At least that's my view at this point in time.
So with the real estate lesson I learned with my father and the stock lesson I learned with my mother, I was a little bit off-put by investing in general. And I thought there's got to be a way to preserve my wealth and even grow it without taking on such extreme risks. And that's when I realized the difference between saving and investing. So from the time I was young, I started to wonder, what is the best form of money? Is there a way that I can just save my wealth over time and not risk it in real estate or in the financial markets? So of course I found gold and silver right away. Those have been fantastic stores of value for thousands of years. They've been the best forms of money on the planet. And then Bitcoin came along, which I heard about in 2014. And I started to wonder, could anything be a better form of money than gold and silver?
So what does it mean to save? Well, effectively to save is to try to preserve what you already had. What you're doing is you're not taking additional risks to try to get additional rewards, you're just trying to preserve what you already have. That's money, and that's why gold, silver, and Bitcoin have no yield. Oftentimes they're criticized that they have no cash flow, they have no dividend, they have no yield, but they're not supposed to. They're forms of money. If you want yield from any investment, you have to take on risk. And sometimes that risk means you're worse off than you started. In fact, most businesses go out of business. Most risks do not pay off.
I want to thank you for watching and remind you that the best investment you can make is your own financial education. And goldsilver.com is filled with free research and ways to help you protect your future. We'll see you there.